This week we will discuss what happens when financial intermediaries do not do their job correctly, which is to facilitate exchange by improving the informational environment they take place in. The required reading for this is Mishkin chapter 12. Remember that asymmetric information is at the core of financial market inefficiencies. Economists sometimes refer to these as financial frictions. When such frictions amplify sufficiently, they can disrupt the collective functioning of the entire financial system, which results in a system-wide financial crisis, separate from problems at a single firm. Financial crises, and especially banking crises, are bad news. They often can occur at the end of an economic expansion, effectively ending it, and they have their own dynamics. While the categorization here follows Mishkin, be aware that there are many variations in practice. Broadly speaking, each financial crisis, however, has three periods: an initial boom period, followed by a crisis phase, and then a more protracted or less protracted recovery phase. One frequent pattern in the pretext of financial crisis is financial innovation, such as the invention of new loan types or securities, and financial liberalization, which generally refers to opening up the financial space either from regulatory financial oppression, say governments controlling lending, or to foreigners more broadly to participate in financial transactions. Financial innovation and liberalization are ambiguous phenomena. Both patterns can make financial markets more liquid or benefit risk sharing. However, they can also lead to excessive credit booms, especially if they get away from regulators, who may not always immediately understand which new instruments are efficiency enhancing and which lead to excessive risk taking or other pitfalls. If intermediaries like finance companies or banks take on excessive risk, extending credit to borrowers who are likely to repay, eventual losses are likely to occur. This reduces the value of intermediaries' assets, and since the liabilities typically remain unchanged, that typically means it reduces their capital and net worth. Now remember in this context that banks have to hold a certain amount of capital for regulatory purposes. In a downturn then, banks will reduce some of the liabilities to meet those requirements, which however also constrains them from taking on additional assets, and for the economy that means that the overall loan volume during crisis tends to decline in a process we refer to as the leveraging. Because firm investment and household consumption depend on such credit, this leverage cycle, sometimes also referred to as a credit squeeze, then amplifies the magnitude of an onsetting recession. Financial crises, aside from credit booms, are typically characterized by a real asset price boom. Could be real or could be financial. 2008, for instance, had a housing bubble. During the 2001 recession, emerging tech stocks displayed bubble-type behavior as well. It's a very common pattern for recessions. A bubble describes generally a scenario in which the price of an asset increases above its fundamental value, that is what it should be worth based on determinants of demand and supply, like risk and liquidity. Once an asset does this for a while, its price may keep rising above its fundamental value at an exponential pace. Finally, some event, like for instance a large investor selling or a central bank tightening rates, can pop the bubble and prices then collapse rapidly. The bubble you're likely most familiar with is the one in front of you. These are US housing prices, which experienced such a bubble in the mid-2000s. You can tell just from looking at this that around 2000 home prices started to increase much faster than they did before, and the pace of this accelerates as time passes. By around 2006, 2007, the bubble sort of plateaus, and then it pops. It falls back very gradually before prices return to something that looks more like a trend path. Now, this is what we refer to as a bubble. The psychology of a bubble is well enough understood. The general idea is that if you're in this area here, what you're essentially doing is you're betting that housing prices are going to keep up going more than they already have, despite the fact that they're above their fundamental value. A lot of investors understand this. So here the hope is that someone else is going to hold on to the expectation longer than you will to reap an extra benefit. Of course, if you buy a house up here, worst time to buy, right? Once prices collapse, you're the one who's basically losing all their income to the people that bought down here. We'll come back to this, but for now, just be aware what happens in the context of such an asset price crash. Based on our discussion of bank balance sheet, it should be obvious why this deterioration is a problem for financial intermediaries. If the value of their assets fall below that of their liabilities, their net worth becomes negative. This is the case of insolvency in which the firm can no longer meet all of its obligations. Now, not all banks necessarily run into problems just because they're insolvent. Remember that one particular issue with banks is that they have very liquid liabilities. You can go to the bank and withdraw from your checking account at any point in time. It's thus plausible to assume that depositors and other bank lenders will try to withdraw short-term lending if they're worried about the quality of their bank's assets. Now, the intermediary's initial response may be a fire sale of liquid assets, for instance like bonds, to meet such withdrawal demand. However, this reduces the value of the assets sold, and it's also a signal that financial markets are in trouble to the general public who can observe this. One risk is then that an otherwise solvent firm will experience similar withdrawals, resulting in their bankruptcy as well. This is a phenomenon we call financial contagion, and is another case of asymmetric information. Lenders generally should not liquidate solvent firms. However, if they do not know who is solvent and who isn't, they may be broadly withdrawing from the financial system, thus triggering the bankruptcy of otherwise sound firms. An individual example of such withdrawals is a bank run, you may have heard of those, in which depositors quickly pull the money out of a single bank, effectively bankrupting the bank, even if it's actually a solvent bank. Now, banking crises especially tend to create some of the longest and deepest recessions that we observe, in part because banks have this hybrid role in the economy. For one, they're an important provider of credit, but they're also a storage for your liquid savings. Many of us use banks as piggy banks. Now, how proactively a government prevents crisis and how well it manages an ongoing crisis then critically determines the eventual cost for the macroeconomy. One ongoing fear in the context of financial crisis is that deflation might set in. And keeping in mind that deflation harms borrowers, it should be obvious, or intuitive at least, that it effectively erodes the net worth of both households and financial intermediaries more, who themselves need to borrow to operate. A historically relatively recent example of this pattern is the 1990 Japanese housing crisis, which was followed by near a decade of deflation. And yes, deflation was not a feature of the global financial crisis, in part because the Federal Reserve responded very quickly. As we'll see, it was, however, a feature during the 1930s, during the Great Depression years, when deflation kicked in for several years at once.